Hello, Marc from ADM Investor Services International. With a look this week at the escalating rate of infections that we've got with COVID and the latest set of IMF global forecasts, both for GDP and above all for the world's debt profile. So let's start off with the first chart is basically highlighting just how much in the infection rate from COVID has escalated, and at the same time also the welcome news by comparison with the earlier part of the year that we're not seeing the sort of escalation in mortality rates. However, that's not a guarantee that that won't change going forward, but hopefully we have at least now mastered better treatment, which is good news. The second chart today is the IMF's latest World Economic Outlook update, and as one can see, basically what's happened is, having been a little bit too optimistic back in April, they revised down very sharply their forecasts in June, and now in October they're revising them slightly better. However, as the graphic says on the chart, it's still a very, very deep recession that we're going through. So it's obviously resulting in lesser government revenues, lesser output in the economy. And as a result, we then look at my third chart today, which is the profile of global public and private sector debt. The only difference between the two on that particular chart is there is no projection for private sector debt. But as one can see, there's going to be a massive escalation just for this year, and it's likely to be quite rapid going forward, in public sector debt from 83% at the end of 2019 to 99% of global GDP by the end of this year, and likely to continue to rise as we go forward, given that there is a clear need to support these economies, which will only be made worse if this second wave of infections creates a greater need for greater economic shutdowns. So that takes us then to well, I should also say in terms of the private sector debt, it's also important to note that we will see a big rise in private sector debt of the sort of order that we're there, which was already much higher, as one can see, at 144% at the end of last year. The only difference, perhaps materially, being here is whereas it was being deployed for equity buybacks and a general sort of debt for equity swap, at the moment, a lot of this debt is being used to cover current costs rather than capex, and that in itself is bad news, because at some stage there is an issue here where the principal rather than debt service costs become more of an issue, and a great weight on private sector corporate balance sheets. So the next chart is one that we all know about. It's about central bank balance sheets and how they've acted as a huge backstop. But as we had comments from Mr. Kashkari, the most dovish of all the Fed members, Fed governors yesterday, he noted that basically what really is needed here is fiscal stimulus. Central banks can't basically put money in the pockets of those who are unemployed or who are vulnerable to layoffs. So what is the effect of fiscal stimulus? Well, the IMF has a nice little chart, which is my fifth one, on the effects of public investment. I think the key here is the importance that it gives a big boost in times of high uncertainty, although the amount of job creation it actually does is actually much more limited than the amount of a boost that it gives to output and earnings. And finally, my last chart is one from the Bundesbank that was published this week, which basically highlights that they're projecting a fairly rapid rise in insolvency, which goes back to that chart earlier about private sector debt. The important thing in this one is it actually ignores the moratorium on insolvencies, because basically a moratorium doesn't mean that a company isn't insolvent. So those are the challenges that we go forward, and we will be reviewing this again on a regular basis. That's all for this week.